Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to another episode of the Finance Garage. As always, Jonathan Wu here, Senior Financial Advisor and Principal here at the SWU Group. And today we're going to talk about another part of the investing sector that we have talked about at the global side, but we haven't talked about locally here, and that's small caps. Small caps often fly under the radar, but really they're the powerhouse of innovation and growth in the investment landscape. And these agile companies actually have the potential to deliver outsized returns fueled by entrepreneurial spirit and market disruption. Yet investing in small caps requires conviction, expertise, and a clear strategy to navigate the volatility to uncover those gems. Today, I'm joined by Patrick Hodgens from Firetrail Investments, otherwise known as Paddy in the industry, and he has over 40 years of experience. And today, that's sort of the primary purpose of why we're here and what we want to dig into. So, welcome, Paddy.
Thanks, Jono. Glad to be here.
So, as I already said, your career spans 40 years, including leading Macquarie's entire listed equities business and now starting up Firetrail in 2020. Can you sort of take us through your journey? What I'm interested in is what first drew you to investing? How did your time at Macquarie shape your philosophy, especially when it came to small caps?
Great. No, thanks again, and thanks for being here. A few questions there, but I sort of, when I do these podcasts on occasion, I always sort of think, what was the impetus and the timing that made me get interested in it? It actually journeys all the way back to year 8, when I was 14 years of age. I was a student in year 8 at Morris Brothers in Hamilton in Newcastle. And I was always very good at maths, but I was bone lazy at everything else. And to me, it was maths and sport. And I was in a commerce class late that year, and the teacher gave us an investment competition, share trading competition. And to me, I just zoned in, nailed it. I actually came first, and it really created that, the interest and the juices in investing. And when you think about it, investing is maths-centric, and it's also very, very competitive. So it really sparked a 12-year journey to get to actually Macquarie, where I became a portfolio manager at the age of 24 years of age.
Wow.
So that was very exciting.
Yes.
So I was one of those very, very lucky people that knew exactly what I needed to do at around 14 years of age. The journey to get there, so I did a Bachelor of Business, Accounting, Finance, got a distinction average, was pretty happy there, did a master's as well, and then really, probably in terms of my work career, I probably mucked around a bit for 3 or 4 years, had a short stint at Westpac, at Citi, State Street, but it was in 1989 I was given the opportunity to join Macquarie, and that was really when it was just such a great opportunity. Macquarie back in 89 wasn't listed. There was about 1,100 people in the business. Today it's a $100 billion plus company with 37,000 employees.
Wow.
So there was a team of 2 in equities. We managed both Aussie and global with just 2 people. I was the junior guy, but because I was number 2, I used to call myself the 2IC.
Yes.
And really, the 28 years I was at Macquarie, I broadly, believe it or not, had the same job for 28 years. Now clearly, the time I started to the time I left, we went from 2 people to 55 professionals. We went from managing $500 million of FUM to $28 billion. And we obviously had every style, whether it was indexing enhanced, large caps, small caps, emerging markets, global, the whole full metric. But in 2017, loved my time at Macquarie. It is a great organisation. we were paid well and we got good bonuses, but because the fund and broadly a lot of the funds were doing very, very well, a lot of myself, but also a lot of the team were getting poached by the peers. Like if one individual was doing really well, the peers look over and go, oh, I think I might steal a few of those, a few of the team. So I went to Shamara, who is now the CEO and was my boss at the time, saying, I need to sort of positively lock up this team, and the best way to do that is to get equity. Now, Macquarie took that very seriously, and it did go all the way up to the board and back, but they made the decision, and I think it was the right one for Macquarie. If we make this decision where you get, individual equity for your small area, it changes the whole metrics of
for the
Macquarie,
business,
for the whole business. Yeah. They couldn't make that decision, so it was disappointing that we left, and it was disappointing for Macquarie, but it was probably no surprises for Macquarie, and that change from Macquarie to Firetrail happened in 2017, where we made the decision to leave in November 2017. As I said, I was managing a team of 55, 28 bill, but I sort of ring-fenced the fundamental team, which is where the small companies, the high conviction fund came from.
Yep.
And we effectively took the whole fundamental team. So all of the portfolio managers, the analysts, the dealers, product specialists, and we left and created Firetrail. And true to what I'd promised, if you leave and join Firetrail, you'll get equity. So 9 of those 10 got equity in the Firetrail business, and almost 7 years later, 8 of those 9 have remained. So it was obviously the right strategy because it kept the team stable. Yes. And today, where we are at Firetrail, we've got 4 products. We run about 6.4 billion in funds under management, and we have a team of 20. So it was a long journey. 40 years is a long time, but I've loved every minute of it, and I've got at least another 10 years in me, I think.
At least
another 10.
So interesting that you said you sort of ring fence the fundamental team. Given the fact that you were running money across every the whole gambit and spectrum, what drew you to the fundamental team specifically? That you thought that opportunity set was in your mind more attractive than the others?
Yeah, probably 2 reasons. The first was high conviction, bottom up stock selection is what really excites me and what excites the team, and providing clients, significant alpha or significant returns above the benchmarks. That was the first thing. A lot of the other funds were, at lower risk and tax effective, or they were sort of country specialists, a Hong Kong based fund or an emerging markets, which was a reasonable skill set across the team, but our specialty was Aussie and then global on the MSCI. So that was the first reason. And the second reason is the way we manage the funds here. We are a high conviction manager. We do take risks to add value, but they are calculated risk at a stock specific level. And what I like about high conviction investing, at least the way we invest, is we want to cover all corners of the market. So where we get into value companies, growth companies, large, smalls, industrials, resources, wherever the opportunity arises. And high conviction, being style agnostic, was what excited the team. And I think we've got a really good skill set there.
Is there anything? Based on your philosophy, talking specifically about the domestic strategies, do you not invest in any sectors? Do you screen out any specific sectors?
There are, in the domestic sectors, the short answer is no. From a global perspective, we wouldn't invest in tobacco companies, we wouldn't invest in companies where, like cluster bombs and the like. But in Australia, you don't have those sort of stocks. So we will look at every company. We've got 3 or 4 points on our philosophy, but the main point is every company has a price. Every company is a candidate to be part of one of these portfolios if they're cheap enough and their earnings are robust.
Over these last 4 decades for yourself, you've obviously seen plenty of cycles in small caps, right? What are the most significant shifts you've observed, and has that shifted or influenced the way that you invest today?
Yeah, so obviously I've been through a lot of mini crashes and changes in government, Trump 2 coming through shortly, but I think the 3 main ones was, clearly NASDAQ collapse in 2000, so the ramp up of high technology companies, and the collapse in April 2000 was a major one. We played that pretty well post that crash. We were, like everybody else, quite guilty of being overweight high tech companies and thinking 40 times price to sales is fair. But we pivoted very, very quickly and did very, very well for the next 2 to 3 years for our clients. That was one, and and I'll talk about some of the insights we got from that. The second was obviously the GFC. We played that incredibly well going in and played it very well on the way out. The GFC was 2008, and the reversal was mid 2009. 2008, we want to be fully exposed to the market, but you've got to have defensive companies with very strong balance sheets. So we pivoted quite nicely into that. And then from April 2009, it was all about, the economy starting to grow very strongly. Defensives were expensive. Let's now start pivoting into leveraged companies that are really facing the consumer and global economic growth. And we played that one very well. And I think that's how we really created a really strong name. This was our time at Macquarie, where we did incredibly well for 4 or 5 years through a downturn and coming out, which is not that common for equity managers. Many equity managers might do well on the way in, but struggle on the way out. And probably the third one is COVID, which everyone remembers. We weren't positioned that well on the way through, but we were perfectly positioned when that pivot happened on the 23rd of March 2020. You needed liquidity and you needed confidence to go hard, and for both the high conviction fund and the smalls, and you can see in the returns, we did really well there. And I think through all of that time, the one lesson is all about ensuring you're liquid. You've got the liquidity. Yes, we are going to invest in great companies that are less liquid. Make sure you've got a balance, like a barbell approach. Have your liquid stocks that might have higher alpha opportunities, but if things go wrong, you need to have liquidity in the portfolio. I think the second thing that the team constantly learns is you need to adapt. History repeats itself, but in different forms. You've got to adapt and move and be different. And one thing I always talk about, as well as, I'm very experienced and I've been through a lot of cycles, and yes, on average, history repeats, and on average that is valuable when you're assessing the future opportunities. But, the market has adapted. So you look at our team now, our average age is 32 years of age. We've got, I think, 9 people in the team under 30. Part of the reason for that, they're incredibly smart. A lot of them have done a couple of degrees, the CFAs, so very experienced from a financial perspective. But you need the younger team that have been through, lived with technology all their lives, lived with social media most of their lives, and now AI. And those individuals are much more open to say, yeah, Paddy, valuation is important, but subscription growth and exponential growth 4 or 5 years out is also important. So you need that balance. You need that experience from a risk management, liquidity, history, but you also need young individuals that can say, things repeat, but this time it is a little bit different. The market is just focusing on technology, AI, social media. And I think that's why, particularly in the small companies fund, obviously I'm the most experienced in that team, but we've got Eleanor, who's 33, Matt, who's 36, and Carter, who's is 26. So we've pivoted and traded very well the Life 360s of the world. And I think if it was just myself and, say, Blake, who's mid-40s, we might have missed that. So having those young individuals to say you need to look slightly differently, I think is a really big positive.
And on that, do you think that there's been quite a number of instances where you felt genuinely challenged from the perspective of your traditional viewpoint of looking at small caps, and then having someone like Eleanor come in and say, oh, that's not how, in a simple way, that's not how the world works anymore. You got to look at it from a very different angle.
Absolutely. And the index itself is changing constantly as well. You go back 10 years ago, very heavy on resources, very heavy on REITs, very heavy on industrials, hardly a tech company to be seen, hardly a biotech company to be seen, where today, tech's a big part of the small companies, because there are a lot of great companies that just aren't big enough when they start their listed journey to go onto the NASDAQ. The absolute classic is Life 360. it's a US company. All of its opportunity is the US and the rest of the world. It's a US management team. The corporate head office is over there, but they listed in Australia because it was small enough, and we've got. Australia is very open to new ideas and opportunities. So there's a lot of companies like that. But yeah, you are right. Having an Eleanor who's got an immunobiology background, she understands biotechs and phase 1, 2, 3 opportunities when they're going through trials. She can provide that extra insight. Yes, I've got more experience in the markets, but she's got vast more experience, particularly in immunobiology and biotechs. Carter, is our technology expert. She's got that understanding, and she can sit me down and go, yeah, from a valuation perspective, Life360 looks terrible, expensive 3 years out. It looks fair value 5 years out, cheap 7 years out, but this has got a 15-year growth runway. And even though it's doubled in the last 12 months, we still think there's, at least from what we know today, 50% more upside. And that's the way you've got to think slightly different. You need to adapt. So still, our industrials are looking out 3 years, but for technology companies, 1, you need to ensure they've got a big moat. 2, very limited competition, but they've got to have that unabated growth 6, 7 years out, and you need to be able to value that. And having Ellie and Carter in particular, they're sort of providing that. So yes, I'm the most experienced, but I'm learning all the time, and I'm learning off these, I call them young guns, because they are young guns. Yeah.
One of the, if we pivot a little bit and talk about the structure of small caps as a market, and it's something that I've been to obviously a lot of different presentations by your team, and as a financial advisor, we've seen a whole lot of data from Morningstar that shows most active managers don't beat the index, right, over time, right, that theory, and there's a lot of statistics that back that. But Aussie small caps is quite different. It seems that the index performance is actually quite poor over time, and it doesn't seem to be all that hard statistically to beat the index. What's different about the Aussie small cap market and the structure of it, I guess, where almost everyone can beat the index?
Yeah, it is amazing. The median active manager beats the benchmark by around 2% per annum. So there's, hard to believe, but there is 98 small companies managers in Australia.
Oh, really?
And 50 of them beat the benchmark by around 2% per annum. So part of the reason is the index construction. Stocks going out of the small ordinaries index into the large caps. Most small cap equity managers are allowed to hold them, so you're on the journey. So Life360 is a classic example. Afterpay, WiseTech was a small company. If you've got a fund that allows you to invest from the 101st largest company to the 50th, you're going to add a lot of alpha there. The second thing is most good small company managers can hold stocks coming in, that are in 400 or 500th in, so they've got 2 years to wait. So you're buying them when no one knows about them, and sort of going through that journey. But I think the main reason is, if you look at the small orders index, most companies outside of the top 10 in that small orders index might have two analysts looking at it. So they're just not researched. The depth of research is just not there. Now, clearly, small companies, each individual small company is more risky because they've generally got one business. Management is a little bit untested, so you need to sort of right-size your position. So the 3 things we always ask before we start to invest is, how liquid is this company through a liquidity lockup, which we saw in 2022?
Yep.
How good is management? We do a lot of work, and we do a lot of management quality scores and a lot of expert network calls just to get an understanding of the depth and the background of that particular manager. And then the last thing is the concentration of a business. Do they only have 1 or 2 tricks to their business, or are they diversified? So you need to take that into account, and if it's less liquid, reduce your position. If the management you think is good but you haven't been able to prove it, or they don't have the track record, reduce your position. If it's concentrated more than an average company, again, reduce your position. So it's all about sort of risk management at the end. There are a lot of very good small company managers in Australia, though. It is, as I said, believe it or not, 98 managers uncovering opportunities. I think the third thing as well is, when you think about IPOs, placements, any sort of corporate actions, 95% of them go into that small cap part of the market. So
Yeah,
if you look,
okay.
and so the large cap managers might be looking at Guzman and Gomez now, for example, but all the small cap managers took advantage of that when Life360 IPO'd, even when WiseTech IPO'd, 7 years ago. They're taking advantage of that. And there might not have been a lot of IPOs in the last 12 months, but there's been, we just calculated this morning, 254 placements and capital reconstructions. There's been 4 this week alone. And, as a small cap manager, if you're nimble enough, you can take advantage of that and get some of that, what we call cheap alpha, which is why, in my view, the median manager looking at stocks that are under research, that are adding a pretty easy 1% above the benchmark there, and then getting those cheap lunches. I wouldn't call them a free lunch, cheap lunches.
No such thing.
with placements and the like.
Okay. I'm going to ask you to lift your kimono a little bit. Over 40 years, what do you think is your best success story, and what do you think has been your biggest challenge? And I'll contextualize this a little bit. Dad always likes to, because Dad's a little bit older than yourself. He's been investing for closer to 50 years, and he always tells our clients that his biggest success story was CSL.
Yeah.
And he bought that, I think, $2 something when it floated. And it's amazing.
I remember that. $1.95.
Yes. Most people do not actually know the full name of CSL.
Yeah.
Right? Commonwealth Serum Laboratory. I think.
Yeah, that's it.
And then it went through like a share split at some point in time where I think became then 80 cents per share. And then he's held it since then till now, which is $200 odd or something like that.
$280.
$280, right? So that's like it was like almost 300 odd X for him, including the share splits.
I think that's right. Yeah.
Right.
Yeah.
Now, lots of failures that Dad has had as well, right? Do you have any of those sort of stories that and does that, I guess, reflect your belief around the true value of really long-term investing? Because most people can't see it for daylight, right?
Yeah. No, to us, that is, first part of our investment philosophy is every company has a price, an opportunity to be part of the portfolio if it's cheap enough with robust earnings. But the second thing, and I've read a lot of books on this and I'm such a true believer, it's time in the market. It's that patience to be a long-term investor is what it's all about. It's not time in the market. So many of our institutional investors, picked COVID and, saved 15% in, Jan to March 2020, but very few of them were brave enough to jump back in on that 23rd of March. So they look like champions for that first 3 months. And some of them today, and the market's doubled and doubled, are still underweight Aussie and global equities because they couldn't pick the time to get back in. Same as when through the GFC, some people picked that pretty well, but again, April 2009, it was a very subtle change, but the market turned very quickly. And then, there was a lot of people that weren't brave enough to jump back in. But in terms of successes, I will talk a couple of stocks, but to me, my biggest success is just hiring outstanding individuals that are passionate about equities, that believe a team approach is more important than an individual star portfolio, and someone who wants to perpetually improve both professionally and personally. And they're the 3 must-haves to get an interview at Firetrail. You've got to, I'm 60 and still constantly learning. Nearly every single person in Firetrail has either done the CFA, which is a 3-year, very difficult course, or have started it. So I want them to keep learning and keep learning. The worst thing you can do under Firetrail is saying, Paddy, I can't learn anymore. I know everything. It's like, well, you know nothing. So I think that's the key sort of personal success. But I think in terms of stocks, we got onto CSL at that same time, but we unfortunately sold it at $55. But that was a very good win. So we got what's called a 10 bagger at that point in time. That was very good. Newcrest Mining was another one which we did incredibly well out of. Got in at about $4 a share, and that recent takeover with Newmont at around $24 a share was a good recovery for us. And I can't take credit for a lot of those. I was in the team, and it's a team decision. Carter Ryan got us for the small companies fund, Life 360 at about $4.50 a share. I think today it was 28. We still own that. We think that's got further to go as well. So there's been a lot of successes where I think we've done well. Haven't done as well as your father though, where 2 to 280. That is very impressive.
Correct. And I think, when you're talking about the GFC, and I remember I shared this with you when we caught up at your boardroom a couple of weeks ago. So I was very early on in my investing journey in 2008. So amidst of the GFC, I don't recall if you were presenting, but I remember attending a Macquarie small caps lunch, and it was at number 1 Martin Place, as it always was, in the ballroom at the Westin downstairs. And basically, middle of the GFC, I think Macquarie Aussie small caps had halved in value, and Dad always reminded me that where you find value is when basically blood's on the street, everyone's just trying to get out, and that's your opportunity to start picking stuff, right, and picking the eyes out of it. And you do have some time at that point in time when everyone's running away. And I remember exactly then I got paid a bonus of like $15,000, and I said, okay, if a fund's fallen by half, I mean, that's an astronomical, statistically, right, anywhere. Now, in 2008, I was 23, and I said, well, you know what, I have a pretty long, investing runway, throw the 15 grand into the fund, and then from there till March of 2009, I think it halved again, right, in that period. That taught me two things. That taught me money's not free, right? And number two, you should also look at more macro factors than just a single metric saying something fell by 50%, right? The other thing that I did was my first ever stock investment was in 1998, so I was 13 years old. Dad said, have a look at this company. It's like the premier building company in Australia called Lendlease. And why I remember it was 1998 was because I bought it at $19.98. It was just a confluence of events, hence why it sticks in my mind. What's the price today? It's like
$6.80, maybe $7. Yeah,
correct. Right now, I didn't hold that stock for that period of time, but I think the one thing I learned out of that was just because it's a household name doesn't mean it's a good investment.
Absolutely.
And I think a lot of people that are not professional investors do get stuck in that theory where they go, oh, I shop at Woolies, I should buy Woolworths, right? Or I shop at Kmart, I should buy Wesfarmers. I mean, is that a nuance? I mean, is from your investing philosophy, I guess, going back to that, is that something very important for your team to sort of isolate personal, I guess, views or things like, I consume this product, therefore it's good. Guzman and Gomez is good because I like their burrito. Yeah. Because we can get stuck into that, right?
Absolutely. I mean, it gives you some more passion if you're a Woolies example, or your Kmart example, or your G Guzman example. But you've got to be totally, at the end of the day, we are investing for clients' superannuation. You can't get emotionally attached. I really like Lendlease because of, they build houses and, that's great, but what do the earnings look like? So you've got to, it's good to have that interest, but then you've got to be dispassionate. Part of the reason for all of the funds, we always have, for the high conviction fund, we have 3 portfolio managers, and small companies, 3 portfolio managers. It's all about to get that diversity of thought and to reduce that bias. And that's the biggest risk anyone can have in the market. Either buying a stock because you shop there could be the right decision, but just because you shop there shouldn't be the main reason for that investment, or throwing out a company because it's had a difficult period. When if you do the work and you say, well, yeah, it's cyclical, it's underperformed here, but all things being equal, again, it's calculated risk. Looking out 3 years, earnings will be back, and we think the price PE will come back as well. Yeah. And I think the only other thing I'll add as well is if you get, say, Ellie on the podcast in the future, or Matt Fist on the podcast, or even Blake on the high conviction, they'll talk about the odd stock that they've had successes, but we're running portfolios of stocks. It's everybody knows somebody, not as well as your father, where it's 200 to 300. Yeah. But everyone's got an example who knows somebody who got into Bitcoin at $2,000. Yes. Got into Coca-Cola Amatil, which is no longer here, but I know people that got into that at 50 cents many years ago, and it ended up getting taken out at $12, or Afterpay at $1.50 and got taken out at $70. But if you've done that, unless you're very lucky, you've probably had 10 other investments where they've either gone to zero. So we're all about having portfolios of our very best ideas. Occasionally we're going to get a Life 360, might get a Wise Tech, but we're also on occasions going to get a Lend-Lease. And the key thing is you let your winners run, but just make sure it's not purely momentum. It needs to be earnings based.
Yep.
And when you make a mistake, you've just got to fess up as a team and take your medicine, move on, go to the next thing. And the one thing you have to do is when you've got out of a company because it's underperforming and the earnings are weak and you're not happy with management, I'm saying all Lend-Lease here, don't throw it out for good, because it might only need two things to happen. New board, which is going to happen, new management, possible. You need an improvement in the global building cycle. Probably doesn't happen in Australia in a couple of years, maybe not in the UK for 3 years. But at a point in time, that will be a company that could be an opportunity. And it still comes back to every company has a price. Doesn't mean you have to invest in many of the companies, but if the earnings are turning, management's improving, and the market hasn't recognised it, they're the great opportunities to jump at and invest.
If we consider risk, that lens specifically, I think a lot of people look at small caps and say, when there is a macro event, small caps just generally get knocked around much harder than large caps, broadly speaking. And things get mispriced very quickly too, right? It's like baby out with the bathwater sort of theory. How do you balance that out at a portfolio level? Because a lot of my clients are genuinely concerned about that, and I get it, right? No one likes volatility. I think fund managers like yourself looking at small caps a lot do enjoy bouts of volatility because it throws up that sort of mispricing opportunities. How do you think it's best positioned with a retail mum and dad with the expectation of that risk but the longer term return profile?
Yeah, there's a lot of questions and a lot of good comments, but the first thing I'd say, small caps, yes, without a doubt, more volatile. One of the big weaknesses of equity investing generally is you're seeing the prices move live every single day. News stands, newspapers sell on fear and uncertainty. To me, the house, a residential house, if you price that daily, intraday, it would move as much. But because most people buy a house and on average they hold it for 7 years, houses always go up. But you look at equities, you buy equities, hold it for 7 years, there's only been one 7-year rolling period where equities have been down. But because people look at the volatility, unfortunately, a lot of people sell at the worst possible time. So how we do it, we invest for the long term. We want clients that are very patient and can invest for 5 years. If you really need money within 2 to 3 years, equities is probably not the right spot, and small companies is almost certainly not the right spot, because you can have a difficult 2-year period, but on a rolling 7-year period, they do pretty well. How we manage it, the way in ours is we are taking risks to add returns way above the benchmark for large caps as well as small caps. But they've got to be calculated risks in our favour, and realistically you only need to be 60% of the right, 60% right to add significant value. Small caps, our hit rate's around 70. High conviction, it's around 58. So we are doing well there. So you've got enough risk in the portfolio. It's directed in stock specific, where we do all our research. From a macro perspective, we do a lot of work around macro, but to us, macro investing is very binary. So predicting what Trump's going to do, the end result in the various wars around the world, whether inflation is structural or cyclical and reduce, what happens to 10-year bonds, the currency, they're risks you need to be very on top of, but we try to reduce those risks because they're binary. You're either right or wrong. 10-year bonds go up or they go down. The RBA cuts or they keep it stagnant. So we want to sort of reduce those risks within the portfolio as much as we can. So the vast majority of the risk is just stock specific. You get the stocks right, you'll beat the benchmark. It really is as simple as that. But, you know, when the market is, or the economy rather, is volatile, small companies are like the end of a whip, if you like. They do move more, partly because they're illiquid,
yes,
or less liquid, partly because they've got one or two great businesses, whereas like even a Lendlease has got 13 different businesses. Westfarm is, for example, a number of different businesses, so they're less volatile, if you like. Some are doing well, some are doing less well. And then company management and the boards are less strong in small companies. But to me, that all means be careful, but they're opportunities, because the market goes, oh, well, that company management's untried, it'll trade at a discount. I'm going, well, it's untried, but if you dig deep enough, they do have a good track record, and I'm buying this company at 20% discount just because it's a small company. To me, it's just an opportunity. So what we do is we're happy to have risk within the portfolio, but it has to be stock specific. And then macro, we do a lot of work, but we want to reduce that down to levels that don't drive the portfolio over the short or medium term.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
So let's talk about the current market opportunity set and how you see it. I mean, large caps, I think that the two most surprising things I've seen in sort of the recent 12 months, like our clients have been obviously exceptionally happy with your returns. What has shocked them is that there's this slide in your deck, which I asked Callum to send to me, I think a fortnight ago, because I was talking to clients about it, is that relative valuation of large caps versus small. And then also looking at the EPS growth for the next 3 years of ASX 100, small caps, and your fund. And it's so odd because small caps have done so well, except on a relative valuation basis, it's cheaper than large caps. And you then think about it, I was talking to a large cap manager recently, remain unnamed because he made certain comments, but like Westpac's share price has done 60% in the last 12 months with barely any earnings growth, credit growth. BDDs are at like record lows for most of these banks. Their provisions are small, except we went up 60%, right?
And I think CBA went up 75.
75, right? Yeah. And so how do you see that dynamic? Because, we always refer to our clients about one of the most important things to invest in at different points of the cycle is this concept called margin of safety. There is almost no margin of safety investing in large caps in Australia or even globally, right? I mean, Mag 7 last valuations I saw was like 33 and the S&P 493 is like 20. Like that's a massive diversion in itself. How do you see that as an opportunity? Because is there a lot of froth in the market? And then how does that play into small caps for you at the moment?
Yeah, it's a good question. To me, I don't think overall there's a huge amount of froth in the market, but the top 10, we've got in our large cap fund, we've got one stock in the top 10. Yeah. The top 10 is basically 50% by market capitalisation of, the ASX 200. 8 of those top 10 are trading at between a 20 and a 50% premium to their historical averages. And when that happens, you think, wow, their earnings looking out 2 to 3 years must be amazing. But the average EPS growth of those top 10 is only 2%. So you're paying 20%, let's say, at the conservative side, premium to historical averages, and you're not getting rewarded for it on earnings. And you say, okay, well, that's part of the reason for that is there's so much money going into the industry funds now. They're investing effectively $6 billion a quarter into the big four banks. So they're sort of buying at any price. Now that'll change when they pivot from Aussie equities to global, or Aussie banks to resources, or Aussie banks to global tech. At a point in time, that will happen. The timing of that, we don't know, but the market does mean revert, and eventually the Aussie supers, the ARTs of the world will move that way. But what's been left behind, both Australia and globally, it started to pick up since about June of this year, is small companies. You look at small companies and their EPS growth is closer to 11% per annum for the next 3 years. And yes, that EPS growth might be more volatile, it might be a bit higher than historically, but very conservatively it'll be 6%, 7%, maybe 8% per annum. So you think if you're getting that much earnings per share growth on small caps versus large, then clearly small caps should be trading at a big premium to the historic. Well, they're actually trading at a 2 PE point discount.
Yes.
So they're cheaper than they've been versus large caps for decades, and they've got 3 times the EPS growth looking out 3 years. So what happens there in 3 years' time? They'll either get to 4 PE points cheaper, which is like 2 standard deviations, pretty hard to get there, or the share prices rally. Or maybe the earnings are wrong, but they can't be that wrong. They might be 1 or 2% out. So to me, it's just now you've got to be patient, because but now is the time to invest for the next 5 years into small companies.
Yeah.
I've got 2 daughters, and they just said, "Dad, where should we invest?" And one's 21, one's 18, and I said, "You've got 10 years, Aussie small caps. When do we do that, Dad? Do we time the market? Today is the best time."
Yeah.
The other thing that gives me confidence from a economy standpoint is, and you look through history, and history does give you this great guide, when any economy slows, global, US and Australia is the same, when it slows, generally, not always, bonds do better than equities.
Yes.
But always, large caps do better than smalls when the economy slows. But on the 9 periods in the last 25 years where our economy has slowed, fortunately Australia has been in recession for 24 years, we slow and we get a bounce back. We don't need a positive 4% GDP growth, which we need get sort of 150 basis points. We feel that's happening now. Equities always do better than bonds, and smalls always do better than large caps. So to me, you've got cheap, better growth, and the economy is improving. Now, the one big risk issue is, what is Trump going to do? But again, if you can not eliminate but reduce those macro risks and just let the stocks do the talking, and have a few that are exposed to a Trump victory and a Trump tariff, but also have exposed to, if he decides to be better on the tariffs, that you'll get benefit there. And if you get the better quality ones on both sides, whatever he does, it doesn't really matter. It's just one's going to do better and outperform, the other will struggle, but it will struggle less than its peers. So that's effectively how we do it.
I was going to ask you about Trump. You've answered that, so that's all good. To finish off, let's talk about a company we've already sort of roughly talked about, Life360. You're not the only manager that is very high conviction in this stock. I find it fascinating from the perspective of one of the golden rules of our practice, because we're primarily family office. We spend 50% of our time managing our money. So before we gave $1 of our clients' money to you, we gave our family money to you first, right? And one of the key things is I need to understand if it makes sense to me as a not very intelligent person. I always say I'm not, because I like to dumb down things to a level that I could explain to someone that's not in finance, right? Because that's where our clients are. And with Life360 as a company, if I dumb it down to something really simple, it is a platform, i.e. not Apple, not Android, platform agnostic tracking company. That's the way I view it.
Yes.
And I kind of go, well, Apple's got AirTags. Samsung has their version. I'm an Apple fanboy. What is so special about this company as a product offering? I understand that it uses that sort of freemium model, right, of Spotify. Like, you can get free and you get most stuff, but you got to listen to ads and stuff like that. And I understand that's the path Life360 is going to. Can you talk us through what's so special about Life360 and how do you view that as a long-term investment? Yeah,
absolutely. And it's a stock that we've picked very well, and no credit to myself. It was Carter Ryan that got onto that early, and it's done so well for so long that we've had to keep selling it because we keep getting close to limits. But when you look back, and I think when you're sitting in Australia, you don't get the opportunity really in Life360 because it is US centric, and yes, we have it in Australia. But when you think about it, They started this in 2008. The CEO, Chris Holes, wanted a safety tracking device through Hurricane Katrina. That's how it actually came about, just to sort of know where your family is, know what's going on. And then it started from there. At its most basic level, that is what it is. It is a tracking device for family, friends, parents to know where everybody is. But when you dig a bit deeper, in Australia we have NRMA or RSEQ in terms of safety and repairs on the road, etc. In the US, you don't have that. So they've got, it's about the fourth most used social app in or downloaded in the US market. 1 in 8 households use it effectively daily, and in Texas, for example, 1 in 4 households use it effectively every single day. So yes, it gives you tracking, but when you think about what it does in the US, it gives you a speeding or a driving track record, which assists you if you've got a good driving track record, never brake too hard, never speed. It goes to the insurance company, they go, wow, you've got a great track record, we'll give you a bit of a discount. It's got the incredible safety, so again, we don't have NRMA and the like. There's options there where you can pay to get that sort of service all around the country. So that's sort of the opportunity. It is broadly a freemium model in Australia. In the US, it's I think there's now 77 million users, and of that, there's about 40% that are happy to pay $15 per month. So it's a bit like Seek, where they do the freemium model over in parts of Asia. They get a dominant market share, and then they start saying, well, it's always going to be free for that basic tracking model, but if you want that security, this and that, you want to attach your tile to it so you know where your goods and services are, then you've got to start paying a little bit. And $15 a month is not a lot of money. The other beauty about this company is, yes, it's a new product, and you might have an Apple sort of looking over their shoulder saying, that looks interesting, but their churn rate, as in people signing up and then going, I don't really get it, is so close to zero. Like once you're on it, you can't let it go. You can't let it go. And then you take 2 extensions. What are the next opportunities? Well, the next opportunity is they bought a company called GeoBit, which is basically a pet tracking device. That is getting fully integrated into Life360. Again, Australia's being the poor cousins, even though it's listed here. They'll do US, they'll do UK, Europe, and then eventually they'll bring this to Australia as well. So they've done that. They bought the tile business, and they're regenerating that. Again, tiles are great where you're paying, I think it's $1 per month per tile, and you say, I've got an expensive bike, I've got a boat, keys, anything, and on your one app you know where everything is all the time. So it's not just the individual or your kids or your parents, it's there. They're doing that another approach for the elderly as well. Not that your dad's that old, but your dad's dad or your dad in 20 years' time, if he is not sort of moving every hour, it sends a response, hey, your dad hasn't moved for an hour, what's going on? Or so then you can sort of ring up dad and say, are you okay? So it's got all those sort of things, and then you think, well, it will go from 77 to 80% of the US population by 2032, I think is the estimate.
Wow.
UK the same, Europe the same. And then when you think about it, yes, at the end of the day, it's tracking. So you've got 77 million people just in the US got their phone, and it's part of people's appendages. You don't let it go. If you lose it, you can't sleep at night. So Life360 knows where everybody is. So the advertising is just starting, and this is more advertising. If you want to pay freemium, we reserve the right to do advertising. If you don't want advertising, you can opt out and pay the price. But a lot of people are paying the subscriptions, but at the same time happy with the advertising, because they're walking past Guzman and Gomez and they say, hey, Paddy, you're walking past Guzman and Gomez, they've got a special right now, $5, because you're a Life360 member. You're walking into Kmart, actually go to the third, so it's just that really personalised advertising. And to be honest, I think that could be the exponential opportunity. So we've got to model the company out 10 years. We've got to make very conservative assumptions on subscriber growth, churn rate, freemium to payment, and the advertising. And right now we think there's still another 50% upside, but that's been really conservative on that sort of advertising opportunity. I mean, this could be enormous. The one risk with any tech company is, doesn't Apple go, we're going to compete with you? So they have the same sort of tile type opportunity. They've got to be different. If they compete head on, their technology is as good, if not better. But if they compete head on, the advertising or that Apple can do will always beat a Live 360. So Live 360, you're doing different colours, more hip, younger cohort to take advantage of that. But I think the one disappointing thing of a Live 360, and it probably is going to go the same way as an Afterpay, is that it's what, about a $5 billion company today. It's possible that an Amazon or an Apple saying, we could try to compete and catch up, but we only need to spend $5 billion, and that's
take you out.
16 years R&D, and you've got positive free cash flow, and $5 billion to Apple is a day's
rounding
revenue.
error.
It's a day's revenue. So I hope it remains a lot longer, but that's sort of the one risk. But you've always got that risk, that look over the shoulder. Does Apple try to build and compete directly? Does Google try to do that as well? Again, it's easier to buy than build. In our view, they've got other sort of opportunities, but that is a risk we need to be mindful of, which is why it'd never be our very biggest position, because you do have that, a very small, but it's a binary outcome if they decide to compete hard.
But even if it's a binary income, and to be very clear to our audience, we are not advocating for people to buy or sell this stock. Please listen to the disclaimer at the end. We're not giving any personal advice. Isn't a takeout target also interesting to you, or not necessarily a risk? Again, simple mind, because someone like Apple will pay premium for takeover, take out the competition. Is that not a good risk, or?
Well, it's a great opportunity, but we think if they can deliver, or we're of the view for Live 360, if they can deliver on the bull case, the share price is trading at 28. It could get to 88 in 5 years' time, but you get that short-term benefit. If Apple took it out, they'd probably have to pay a 60% premium. You're getting 60% rather than 3 times. Yep. But I need to reiterate as well, we invest heavily, and we do like Live 360, but we have a balanced portfolio. Right. We've got 45 stocks in the portfolio. It's not a Live 360, let's throw it all in there. Yep. The position in Live 360 is around 4.5%. It is a very high conviction position, but because you've got that volatility and the unknown factor of Apple, it would never be more than, say, a 6% position. So as it outperforms, we will take a bit off the top. So, and we always want that balance of portfolio, balance of stocks within the portfolio.
And that's exactly what we communicate with our clients day in, day out. Right, the only free lunch you'll ever have in investing is diversification, and diversification. And we do that with the individual funds that we use. So everyone, just remember that. So Paddy, thank you very much for your time today. I think that was a wonderful sharing of your views on the market, your investing journey for 40 years, what you've learned, good or bad, and to finish off talking about Life 360, which I've learned a lot just in the last 5 minutes, a lot of things I didn't know. Thank you very much for your time.
No, thank you, Jono, and happy Christmas everyone as well, and hopefully we have a safe holiday period.
Thank you.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.